One fund beat the S&P 500 by more than 6 percentage points a year over the last decade. Almost nobody who owned it actually earned that. And the reason isn't fees or taxes or bad luck. Here's the thing nobody tells you when they show you a backtest. A return on a chart is a number. A return in your account is a number you had to survive. Those are not the same thing, and the gap between them is where most people's money actually goes. Today I want to show you exactly how big that gap is, with real numbers from the fund's own documents, and then show you the one thing that closes it. Because it isn't picking better. Let's talk about the NASDAQ 100. If you own QQQ, this is your fund. Over the 10 years to the end of June 2026, it returned 22.07% a year. The S&P 500 over the same decade, 15.51%. That's a gap of about 6.5 points a year, compounding. On a 10-year chart, that looks like a solved problem. Buy the more concentrated, more technological index, wait, get paid. But watch what happens when I change nothing except the window I'm looking through. Same fund, same document, all figures to the end of June 2026. 1 year, 34% a year. 3 years, 26.5. 5 years, 16.5. 10 years, 22. Notice that those don't line up in a neat order. 5 years is worse than 10. And if I zoom all the way out, the whole life of the fund, we'll get a completely different number again. This is the first thing I want you to take seriously, because it's how almost every investment gets sold to you. Nobody shows you a bad window. They show you the one that makes the case. And there is always a window that makes the case. So here's the question that matters. If this is as obvious as the 10-year chart makes it look, why isn't everyone rich? Because look at the same fund over its whole life. Since it launched in March 1999, QQQ has returned about 11% a year. 11. Not 22. And I want to be precise about why, because this is where people get misled. That launch date is not neutral. March 1999 is about a year before the dot-com peak. So this number isn't proof that the NASDAQ is secretly mediocre. It's proof of something more useful. When you start decides what you get, and you don't get to choose. Here's what living through that actually looked like. From its 2000 peak, the NASDAQ 100 fell around 80%. Not 8, 80. Sit with that. If you had $100,000 in it, you watched it become about $20,000. And it did not get back to its old high for roughly 15 years. 15 years underwater, that is not a dip. That's a decade and a half of opening your account and being wrong. And this isn't just a NASDAQ story. The S&P 500 fell about 57% from October 2007 to March 2009, measured on daily closing prices, and didn't close at a new high until March 2013, 5.5 years. Then compare that to 2020. The S&P dropped about 34% in 33 days. 33 days. And it was back at a new high by that August. 6 months, start to finish. Put those two side by side because this is the part people skip. Same index, one hold took 5.5 years to climb out of. The other took 6 months. And on day one of each, standing at the top looking down, there was no way to tell which one you were in. That's not a failure of research. Nobody knew. The person who sold in March 2020 to wait for clarity was applying the lesson of 2008, and it cost them because 2020 was not 2008. So the honest version of just buy and hold is buy and then hold through that without knowing which one it is. Most people don't, and we can measure exactly what it cost them. JP Morgan runs a calculation I think about a lot. $10,000 in the S&P 500 in 20 years, 2006 to the end of 2025. Stay fully invested the whole time, 11% a year. You end with about $80,600. Now miss just the 10 best days. 10 days out of 20 years. You end with about $35,900. You didn't lose money. You lost more than half your final wealth by being absent for 10 days, and it keeps going. Miss the 20 best days and you're down to about 21,000. Miss 30 and you're at 13,800 after 20 years on 10,000 invested. Miss 40 days and your annual return goes negative. You end with less than you started. 40 days out of roughly 5,000 trading days, under 1% of the time in the market decides whether 2 decades made you money. And here's the part that makes this genuinely hard, not just a scolding. 6 of those 10 best days happened within 2 weeks of the 10 worst days. Think about what that means. The best days aren't scattered across calm, sunny markets. They're clustered in the middle of the panic. The exact moment your instincts scream, "Get out," is the moment the recovery is being handed out. Selling to avoid the worst days is how you miss the best ones. They're the same week. Morningstar puts a number on the damage. Over the 10 years to the end of 2024, the average fund returned 8.2% a year. The average investor in those funds earned 7.0. Same funds, 1.2 points a year lost purely to when people bought and sold. Now, I want to flag something because you'll see this statistic thrown around carelessly. That gap gets quoted as, investors lose 15% of their returns to bad timing. And there's a peer-reviewed paper in the Financial Analyst's Journal arguing that framing overstates it. Morningstar themselves warn against reading it as a dumb money parable. So take the direction, not the decimal. The drag is real, it's measurable, and it's caused by behavior rather than by picking the wrong fund. But there's a detail buried in that same report that I think is the single most useful thing in this video. Morningstar sorted funds by how volatile their money flows were. In other words, how much investors piled in and bailed out. In the calmest quintile, where people mostly sat still, the gap was about 0.8 points a year. In the most volatile quintile, where money sloshed in and out, it was 1.8, more than double the damage from the same market with the same funds. The variable wasn't skill or information, it was how often people touched it. And the worst category of all was sector funds, the thematic, narrow, exciting ones. 7% for investors against 8.5% for the funds themselves. The more specific and story-driven the bet, the more people mistimed it. And if you want the deepest version of this, there's research by Hendrik Bessembinder that reframes the whole thing. Looking at every U.S. stock from 1926 to 2016, 57% of individual stocks failed to beat 1-month Treasury bills over their lifetime. The single most common lifetime outcome for a stock was losing everything. And just over 4% of companies account for all of the net wealth the entire market created. That's what you're really buying when you buy an index. Not average performance, a ticket that guarantees you own the handful that matter, because nobody reliably knows in advance which ones they are. So let me give you the one sentence worth keeping. The return you earn is not the return of your strategy. It's the return of your strategy, minus everything you did to it while you were scared. Which means the highest value skill in investing isn't research. It's building something you will not abandon at the bottom. And that usually means a worse portfolio on paper than the one you'd pick if you thought you were fearless. Whatever you can hold through a 50% drawdown beats whatever you'd sell at the bottom every single time. So here's what I'd actually do this week. Go and look up the maximum drawdown of whatever you're holding right now, not the return, the drawdown. Then ask yourself honestly whether you'd have stayed. If the answer is no, you don't have a portfolio, you have a bet. This is educational content, not personalized investment advice. Do your own research before putting money anywhere. If that was useful, a like genuinely helps this channel find people. But here's what I actually want. I've got 3 ideas for the next one, and I don't know which is the most useful to you. So pick one in the comments, or write your own, and I'll read it. Subscribe if you want it when it lands. And thanks for staying to the end.